I'm James Davidson with Davidson Law Group, and today I'm here with John Morrison with the Morrison Firm.
Thanks for having me, James.
What are some of the taxation considerations for somebody if maybe they're thinking about selling it on their own that they could fall into?
Well, some of the tax implications really depend on the underlying entity structure itself, whether it's a corporation, if that corporation has made certain tax elections, if it's an LLC. Also, the domicile of the state can make a huge difference. As we're in Texas. Texas has a fairly unique taxing regime, whereas other states do charge state income tax, and so that can be a world unto itself. Really, one of the biggest things I see, though, and it's an interesting situation where the seller and the buyer are at odds on this particular point, and it's where a more sophisticated party could take advantage of the other party, and that's with the difference between the sale or purchase of assets in the business or the sale and purchase of the actual entity itself. Some really large considerations there and how that works out.
Differentiate for us the difference between selling assets or selling an entity.
Well, from a tax standpoint, if you were to go as a buyer, you were to go buy the assets of an organization, you're walking into what's called a new basis in those entities. And the basis is really important because basis is what your depreciation is based on. And so as you buy the assets, you get a basis on the date of purchase, and that basis then becomes your depreciable basis to then offset taxable income in the future. Alternatively, if you were to buy the entity itself, you're buying the entity level, and the entity then it owns those depreciable assets, and so you're buying those assets at the basis the entity owns them in, and you're just carrying forward the depreciation.
So let's break that down. How do you quantify that into savings? So in what scenario would you be saving or potentially losing out on an opportunity to save?
Sure. Well, so in this particular instance, let's just say, just for round numbers, you bought an entity for $1 million, and as the buyer of that entity, let's say half of the physical assets you purchased were actual identifiable property, plant, and equipment. And so that $500,000 had been fully depreciated. Well, as you move forward, you have no depreciation to take against the future income. So if you are a taxpayer in the highest marginal tax bracket, that could cost you 40% of the dollar value of the $500,000. So over the course of a period of time, that could cost you $200,000 in tax that you're paying that you wouldn't have otherwise paid had you purchased those assets directly. So the difference between the identifiable value of physical assets and the value you pay for an entity is booked on your books as goodwill. There's some interesting considerations there in terms of banks often completely write goodwill off in terms of your bankability and all your financial metrics, and you can never depreciate goodwill or take it as a loss against any income unless or until such time as you are able to sell that entity to someone else. Which maybe years and years down the road, and so at the end of the day, it's causing a tax burden. It's causing some bankability issues that you may never have real visibility to with your lending capacity, and it can create a mess.